Hello, good morning everybody. My name is Brian Wagner. I'm the Chief Architect of Prodigio RTS, and we're going to talk about some intermediate/advanced topics in Prodigio Wizard Lab today. Going to show you how you can use the Strategy Builder's Add to Position component in order to apply technical analysis, in order to double down or even more on positions as you have good trading ideas. Prodigio RTS, it's the robotic trading system available from Thinkorswim, exclusively offered by TD Ameritrade. In order to get Prodigio, you need to be activated. So if you don't yet have Prodigio, request Prodigio activation by sending an email into support@thinkorswim.com. Subject line Prodigio activation. Make sure you give them your username and account number, and they'll get that set up for you. As soon as you have activation, you will get Prodigio as a launchable icon under the Tools section of the Thinkorswim trading platform. And what this is it is a project that we've been working on for some time, which allows you to perform technical analysis and script-like trading automation without any scripts whatsoever. If you want introductory videos or basics, all of these videos are always archived on our home on the web, www.prodigiorts.net. There's a section under Video Archives, and every one of these presentations is archived there. If you have any questions about the platform in general, send email into prodigio@thinkorswim.com. They'll be able to answer account-specific questions, etc. But if you have general trading strategy building questions, we strongly encourage you to come into this Prodigio chat room available on the Thinkorswim platform. It's the Prodigio chat, and usually there's people here during market hours. It seems to be busiest in the morning, but there's people here. They're willing to help you. They're willing to look at parts of strategies and ideas, etc., and you can get some immediate feedback. As always, we have our forums on the web, www.prodigiorts.net. And follow us on Twitter for updates about the platform. That's twitter.com/wizardlab. All right, going to get started, going to roll right into it today. What I have in front of me is the fruit of what I've been working on. Now this is very simple, but I want to explain the philosophy of what exactly I'm doing here. Now, Prodigio, if this is your first time seeing Prodigio, I strongly encourage you to check out some of the archived chats where we talk about basics. This is kind of an intermediate level chat today, but what it is it's a simple application that allows you to drag and drop technical analysis studies and combine them together in order to form trading signals. The management of those trading signals is composed by combining all those signals together in the strategy builder, and this defines how the system will place orders. It's a completely server-side scanning system, which means it runs 24/7, and you don't have to have your computer running in order to have the scans continue. You can scan using robotic trading or trade optics. The robotic trading is full portfolio integration with your Thinkorswim account, and the system will apply your strategy, and it will trade, put trades on, take trades off, etc. on your account in real time. Trade Optics presents you with a queue of all of your trading scan ideas, and as those signals come into the queue, you can elect to trade them, and you can use the various automation tools inside of Prodigio in order to facilitate this semi-automated form of trading. But today we're going to focus on a specific component inside, and that's the add to position part of strategy building. Now when you build strategies using Wizard Lab, you've always got a scanning rule, and we talk a lot about management rules. And what this is you build some kind of technical analysis rule using the rule builder, which is going to say when the signals fire. So for example, I look at a chart, and here's a back test that I was running, and this back test was showing me where the signals were happening. So it was going long here, it was going long here, etc. Those signals are represented by the rules, and you quite simply combine those together in the strategy builder using this drag and drop interface to define which rules should get into positions and which rules should get out of your positions. Now that's the easy part. The scanning rules are those rules that are getting into the positions, and the management rules are those rules that are getting out of positions. So I've got an example that I've been working on. It's something called trend down. So it's got a very, very simple name. This strategy trend down that I've created, and let me simplify this for a second. I built a strategy which is looking for downward trends in the market. It has a rule called trend down. Now this rule is going to be scanned by the engine, and when it's scanned it's going to get into position. That's going to be my entry signal for a position. And that's the scanning rule. Well, inside the strategy I've also got a management order, which is a simple trailing stop order. When it gets in a position, it's going to put a 1% trailing stop, 1% offset trailing stop against the position to protect the position. So this is a strategy in its most basic sense. I have a rule that's going to fire into it, and I have a management order that's going to protect the rule. Now I'll show you how I have this set up, but we're gonna run this as is, and I'll show you what this is doing. So I'm going to take this strategy, trend down strategy. I'll run it over the past month and a half on the S&P 100, and of course this is our back testing module. When you run the back test, you can select your symbol set that it runs over. You can select your back test parameters, etc., and you can select your back test start and end dates. So this is a strategy which I was having some pretty favorable results with in the downside. And scroll down here. So I just have a result set showing the positions. And this, in the past 2 months, is a profitable trading strategy. Now it's very simple, right? And then I'm gonna talk a little bit more about the simplicity of it a little bit later. But this is very simple, but it's a good foundation to start on, especially for this chat. So I've got a trading strategy, and it's giving me some profitable results. And the idea is, well, this is a trend-based strategy. So how do I double down inside of positions inside of Prodigio Wizard Lab? And you don't have to always double down. You can get another 50% of the position, to go short. In this case, this is a short-based strategy, or you can. It's percentage-based. So if you say 100%. That would be a double down, 100% of my position. If I have 100 shares, 100% of those shares is another 100%. So 100% would be a double down, or 50% would be to get into an additional 50 shares, etc. Well, before I get into that, let me show you the basics of what this is actually doing. And again, I want to stress, this is very simple. So my strategy builder, it says that I have this trend down scanning rule. If I go into step 1, the rule builder, let me open up that trend down scanning rule. Now you'll notice what I have here looks very simple, and that's because I have what I refer to as a combined rule or a chained rule. In other words, this rule is nothing more than the concatenation of 2 other rules that I had previously saved. So this rule is combined by taking this cross down rule. I have a rule called cross down, and I've also got a rule called moving down. Right? So each one of these are rules, and they'll independently fire signals. I'm combining those together inside of a master rule that I'm calling trend down. And that's all there is to these combined rules. It's just that when you build a rule, you can chain them together, and you do that by simply dragging them out from this My Rules toolbox. Any rule that you save is going to end up inside of this My Rules toolbox, and you can use those rules to combine them together into larger rules. So let's break this down, and let me take a look at the cross down rule. So I can go to the cross down rule, I can right click, and I can open this, and again, here's a very, very basic rule. This was a rule that I built using the rule builder by dragging out studies in order to represent an exponential moving average crossover. So I'm taking, on the left, I'm starting with my source data, 5-minute OHLCs. I'm sending those 5-minute OHLCs into an exponential moving average technical analysis study, and I'm looking for a logical operator called cross below. So this is saying, as OHLC data flows into the system, perform a 3-period exponential moving average on that data. Also perform a 20-period exponential moving average on that data. And when the 3-period EMA crosses below the 20-period EMA, that's going to fire a signal. So very basic, very simple. This is done by simply going over to your technical analysis toolboxes and dragging out the study that you want to use. So when I dragged out the exponential moving average, all I did was drag it out onto the canvas, and this represents an EMA study. Every study has inputs and outputs, and I have to connect this inside of my rule. So this is very simple. When I drag this out, I can just move it into position, and I can say, as the system receives OHLC data, send that output into the input of the exponential moving average function. Send this output into input B of the cross below. And sometimes there's multiple inputs. For example, cross below, you have to have two things that cross in this case. So I'll change this back to 20. And that's the simple cross down operator. So for 5-minute OHLCs, let's take a look at, I don't know, the speeds of moving average for this rule. On my Chart Trader Pro, I've got a 3-period exponential moving average, I've got a 20-period, and I've got a 50-period. And I'm looking for movement. And there's two ways that I'm going to analyze movement. Number one, I'm just going to use simple exponential moving average crossovers. And then in the next part, where it gets more interesting, I'm actually going to look for divergence. Now you can do this with MACD, and maybe I'll try to apply that to MACD at the end of the conversation. But there's a really simple thing that you can do. You don't even have to look at the MACD. Right? So I'm going to explain what I'm doing here. But this exponential moving average crossover that I'm representing with my Wizard Lab rule, that's the white line, the white exponential moving average, crossing below this cyan line, the 20-period exponential moving average. So, for example, here's an instance where this white line crosses below the cyan line. And this, when this happens, would generate a signal on this bar, the bar after the cross actually happens. So in backtest trading, it's going to trade somewhere between these two bars right here after the cross happens. So that's very basic, that's very rudimentary. And to complete this, I want to show you the other side of the rule. Remember, this was trend down, right? And we had looked at the cross down rule. So that cross down rule is nothing more than that 3-period EMA crossing below the 20-period EMA. I've also got a rule called moving down. Let's take a look at that rule. Again, this is another basic rule. This is one where I'm looking at the 20-period exponential moving average, and I'm looking at a 50-period exponential moving average. I'm using a less than operator. So all that's saying is that the 20-period EMA has to be below the 50-period EMA. On the chart, it means this 20-period cyan EMA line has to be less than this 50-period, this is almost a peach color, 50-period exponential moving average. So in other words, I have to have a general bearish trend in order for this to fire. So it's a trend-based strategy. In other words, if I'm moving down and I get a trigger signal, that's going to fire signals. And it's very basic, and I wanted to point that out. You can probably improve on this by using other indicators such as CCI and RSI and stochastics, and using perhaps other linear regressions, etc. But with that in mind, I'm going to get to the real meat of this presentation. So this rule by itself, this trend down rule, is already giving me favorable results in backtest. Right? So you notice that the ratio isn't perfect. It's 602 winners to 619 losers. And again, I'm running this in raw mode. Raw mode is where you don't really apply your simulated portfolio settings. You can toggle between these using simulated portfolio and the raw mode. But what I like to do when I am looking at the analysis of the rule and how it's firing, I like to put it in raw mode as the first step. When I'm designing this, it really shows me where all the signals are happening without biasing it to the limits of a portfolio. So that's a really good way to start developing the strategy in backtest. Use raw mode. Then when you refine it, you can go and switch over to the simulated portfolio where you can apply actual buying power and risk settings. So those are the results I get with just the rule itself. And again, I've got a simple trailing stop on here. It's just a 1% trailing stop. And I've got an additional rule that I'm going to add to it. So now we're going to talk about this add to position part of a strategy builder. This is something that we don't often talk about. And the reason is it's more of an advanced approach to trading. This is a module which, when you're in position, the engine is going to be scanning for any rules that are looking at the add to position, that are placed under management add to position. If you get a signal from a rule that's placed under the add to position, what that will do is that will add more shares onto that position. So this is a strategy which the side is sell. So this is a short strategy. If I add a rule to the add to position canvas here, and I can add more than one of those rules, as I'll show you momentarily, that's going to go further into the short position. So for example, I built this rule called breakout breakdown, and I can drag that into the add to position canvas from my management rules. Now notice there's the scanning rules and there's management rules. I have to drag this from the management section. And what I've got now is I've got a strategy that has three parts to it. It has the scanning rule, it has the trailing stop management rule, but it's also got one more rule, which is add to position. Now I created this rule using the rule builder. It's called breakout breakdown, and I'll show you what is inside of that because that's actually pretty interesting. But what's happening here is I've got a position percentage specified here, and that's set to be 100%. And what that means is when this rule fires, if I'm short 100 shares, it's going to sell another 100% of the position. So in other words, if I'm short 100 shares and this rule fires, it's going to sell another 100 shares, effectively going short 200 total shares. Now some things about the add to position that you need to know are that each one of these rules fires once and only once. So if you have a, this is done for protection, if you have a rule that could potentially fire multiple times, this won't continue doubling down. For example, if it were allowed to continue doubling down, you might run into kind of a bad situation where 100% of 200 shares, continuing my example, would be another 200 shares. So if it doubled down again, you'd be 400 shares short. And then if it triggered again, you would be 800 shares short because it would double down again. And if it triggered one more time, you'd be 1,600 shares short. Well, we prevent that from happening by allowing these management add to position rules to only fire once. Now that said, you can add more than one rule here. So for example, I can add as many of these as I like, and as long as these rules are kind of tiered, I still can double down, triple down, etc. And I can tweak these position sizes to be, less than 100. So you can add as many of these to the add to position as you want. They'll fire only once, and there's one more caveat that you need to understand. Because this system also has risk management incorporated into it, the add to position will only kick in if the position is still in the entry mode. So all positions that are managed by the Prodigio robotic system, they have different states, and in fact it's governed by a state machine. When a position is entering, it's considered being in the entry state. And then when it starts to close, it transitions over into the exiting state. So what that means is these add to positions will work as long as you are still entering more and more into the position. As soon as one of these management close position rules fires, or the position is liquidated, it kind of turns off this add to position. And again, that's designed so that the robotic system can protect the account and it won't, for example, get out of control. As soon as it begins liquidating the position, it considers this in the closing state, and the add to position will no longer fire. So it's designed to be kind of this three-step procedure: scan, add to position, and close. It's always in this sequence. And once it gets to this last phase, this closing position, it will continue to move on and it will close the position. So with that said, I want to show you the difference that this rule has on this strategy. So I added this breakout breakdown rule. I'm going to save it and I'm going to run this backtest. Now watch what happens to these results. The net P&L, at least for the raw signals, is around 7,700 positive. I can run this again, right? And so I'll let these backtests run on the server, and when this comes back, it'll show me the difference between adding that add to position rule and not having that add to position rule. And you'll notice what happened in this case is that the net P&L, it almost doubled actually. It went from 7,700 to 15,500, right? And now, again, you have to bear in mind this is raw mode, right? And so this may not extrapolate perfectly to the simulated portfolio mode, but at least in this shorting strategy, this is a definite improvement on what was happening. Now, notice the number of winners. It's slightly biased to a little bit worse than it was, but it's still not too bad. The other one was about 602 to somewhere around 900. Right, this one is 575 to 941, so it's a little different, but it's not overly different. Now what this is doing is it's actually doubling down on winning positions. Right, now there are some losing positions that it doubled down on, but watch this distribution here. See, these 200s are all in here. Now littered about kind of in the middle, you'll see 100s. I'm sorry, I should be pointing at this. These are short positions. So some of these positions are going short for 100 shares and some of these positions are going short for 200 shares. Now the big winners at the bottom, the really big winners, notice some of these winners are very, very, very big winners. Let me take a look at, let's say, this MA short, for example. And I'll move over. And what date was that on, actually? Let's see, this is the one that, and I actually have these sorted by net P&L, so this is the one that started on May the 20th at about 1:15. Let me move back to that, May the 20th. So here's the 18th, and okay, so here's the big winner starting from May the 20th. It got into position, and then some rule said that it was time to double down on this position. This is actually a perfect example in this rudimentary strategy. It was going short, it was getting profitable, and then all of a sudden it gaps down. And the gap has a continuation. And this strategy takes advantage of that gap continuation. Let's take a look at another example. Here's an FDX trade, and it went short 200 shares. So every time you see 200, that means the add to position rule kicked in. On June the 2nd at 1:35. Scroll back to June the 2nd. Let's see here. And there's actually two trades here that looked pretty good. This would have been this signal right here. Let's see. No, this might have actually been the losing trade. Let's see, 135. 62, 130. Okay, so this was actually this signal, which again, on FDX there was a similar kind of gap that happened, and we had a continuation pattern on this gap, and it continued to go down. And you can see this short just simply rode this position all the way down. All the way down until the trailing stop finally kicked in. So this was a beautiful position. That's why it's such a big winner. But something in the strategy fired a rule, and that rule said, okay, it's time to add more to position. We notice that it's a gap, and perhaps you have technical analysis that identifies the gap, and not only that, identifies the continuation pattern. Whenever you're doing gap analysis, you always want to kind of classify the gaps because there's various things that can happen on the gaps. There's a gap which, this is a continuation pattern, but there's also obviously the reversal pattern inside of the gap. So it went short here, right? And I want to talk about what that rule actually was that added more to position. So as of right now, it's very simple. It's a very simple process to apply this concept. I've shown you how you can add a rule into the management of a strategy so that it adds to a position and doubles down. Now I can tweak this. I can, scale this up and down, as I want. But here's one where I just said completely 100% double down, etc. And of course, I can add more of these to it. And as a matter of fact, in what I'm about to show you, you can even change the parameters of this rule to make it stronger or weaker. Right? So what's actually happening here? How does it know that it's time to double down, that the trend is continuing, that it's a good trade and I should add more to this position? Well, what I'm doing is very, very, very simple. So let me go and let me open up that rule for you. Once again, that was a rule called breakout, breakdown. So this is what I had up at the very beginning of the presentation. And I kind of want to walk you through the logic of this rule and what it's doing. So as you can see, it looks very simple. You'll notice that there's a cross above in here, and there's a top section, and there's a bottom section. So we're looking for the top section to cross above the bottom section. And then the last part is just this signal, and that's the end of the rule. So what's this top half and this bottom half? Well, it's very simple, and it's related to a MACD. I'm working on 5-minute OHLCs. So the source data that I used for this rule is all 5-minute OHLCs. So it helps if I look at a 5-minute chart. Now, this trade, it's a pretty good example, but it's a very extreme example because of the gap. So what I would like to do is I'd like to take a look at a result which was profitable, but maybe not as profitable. It was a winning position, but maybe not so extreme. So let's take a look at this ExxonMobil position. And this was the one on June the 1st at 11:40. This is actually a much better example for the philosophy of what I'm trying to do. Now, as I demonstrated before, this is a really simple strategy based on 3 speeds of exponential moving average. So let me really zoom in here on this signal, and I can always drag this y-axis upwards like this, and that'll kind of allow me to pinch in a little bit so I can clearly see these bands as they're moving. Well, the trade got in because, as you recall, it had to be trending down, and I define that with a very simple cyan exponential moving average being below this 50 period. So the 20 period has to be below the 50 period. And the trigger was when this 3 period came back up and crossed back down below. So that's a very good idea if you're looking for the whipsaws. You always, I know people say that you can't always buy low, sell high, buy low, but you can kind of incorporate these ideas into your technical analysis. Here we bias our trade by saying it's in a downtrend, but we're really trying to capitalize on the reversals and the kind of whipsaws that are inherent in the movement of these, all these securities. So this is where it got into strategy, and what I'm doing is I'm actually looking at the difference between the white and the cyan band. Right? And notice what happens here. There's always a difference between the white and the cyan band, and this is really what happens inside of a MACD. Let me pull up a MACD because this would probably be a great analogy. So here I'm looking at a MACD, and the way MACD works is it operates on a similar principle. It operates by looking at the difference between 2 exponential moving averages. And what I can do is I can actually match the speeds here to what I am doing inside my exponential moving averages at the top. So let me change this to 3, and let me change this to 20. Right, I'll hit done here. And let's see. I may or I may not have all of these perfectly lined up, but it's going to illustrate the point actually. What happens is the difference between these two moving averages, they change with time. And that's exactly what the MACD shows you. It takes two moving averages. It actually takes the moving averages of the differences, but the point is more or less the same. You see how this white line gets farther away and closer to the cyan line. Well, that's exactly what happens with the MACD. You have two speeds of moving averages, and this red line gets closer to or moves further away from this orange line. And the difference of that is called the histogram of the MACD. Well, I'm using the same thing. I'm using this histogram, if you will, and sometimes the difference is positive, sometimes it's negative, but it changes, right? And it changes, and by the way, when you see this teal area, that's because it got into a backtest position. So during this time, this is where it was short, and it was short from this time into where it closed on the right-hand side of the trade. But the point is that these moving averages, they converge and they diverge from one another. And this tells you something very important, and that's why the MACD study is so important. It tells you the degree to which things are moving. So notice what happens here. As the price moves, it starts to break down and pull away from its moving averages. That's represented by this white line pulling further away from this cyan line and this peach 50-period EMA line. So this white period, it pulls away from it. Now there's a slight pullback, right? So the white line comes back closer to it, but the white line then begins to pull back away from the cyan line. Now this difference is what I'm capitalizing on in order to identify whether or not the trend is continuing, right? And so you can do this using just the raw math, kind of like I'm doing here, but you can also do it using a MACD, right? So I'm going to explain the raw math part, and then I'm going to go back and I'm going to do the same thing using the MACD so you can see how you can kind of use both of these in the same way. But here's how I'm doing it with the raw math. Now, like I said, I'm working on a 3-period EMA and a 20-period cyan EMA. So I've got the white line and the cyan line. Let's go back over to the Wizard Lab Rule Builder. So you'll notice here I have 5-minute OHLCs, I have a 3-period EMA, and I have a 20-period EMA. In order to get the difference between the two of those, I can simply subtract those from one another. And what that'll do is that'll give me the positive or the negative differences. Right? So if this 3-period EMA represents the white line, and if this 20-period EMA represents the cyan line, if I subtract them, that's going to give me the difference. Right? Now, when this white line is above the blue line here, the cyan line, I'm going to get a positive difference. It's going to be some difference, and it's not going to be very big. Actually, that's going to be, if I look at these moving averages, it's going to be 83 minus 82.95. So that's 5 cents. That's going to be a 5-cent difference. Now, when the white line is below it, so here I've got an example where the white line is at $82.90 and the cyan line is at 94 cents. That's going to be negative 4 cents. Right? So it's going to be a negative number when it's below it, and it's going to be a positive number when it's above it. Well, what I'm doing is I'm taking that difference, positive or negative, and I really don't care in this case. I'm putting this on an absolute value. Right? And an absolute value, of course, that if it's negative, so if it's negative 4 cents, it's just going to make it 4 cents. That's going to make this rule kind of ambidextrous. I'll be able to use this in both the breakout and the breakdown by using the absolute value, and that's why I'm doing that. Well, what I'm doing here is I'm actually comparing this difference against its standard deviation. Now let me talk about this. This is not as daunting as it sounds. One of the earlier chats that I gave a couple weeks ago was about how you can kind of measure trend using standard deviations. All standard deviation is it's kind of a measurement of volatility. It's kind of like the average volatility, if you will. That's really all it is from kind of a intuitive standpoint. Right? Now, you know, there's some math going on there, there's some statistics going on there, but all it's doing is it's saying on average the spread is going to be some amount. That's really all it's saying. So what I'm doing is I'm taking whatever the spread is, and this standard deviation, it's always a positive number, And as a matter of fact, it's the number that's used inside of Bollinger Bands in order to get the nice bands. Right, so I illustrate this a lot, but it doesn't hurt to do this one more time. Whenever I have a Bollinger Band, I've got these really nice green lines around my price data. Right, Bollinger Bands give you kind of a range for where the price should be between, and that range is based on the volatility of the movement. Well, this is based off of standard deviations. It's giving me kind of a range of how the price moves. Well, what I'm measuring is actually a similar range for the divergence, for the histogram, for the difference between those exponential moving averages. Right? So I'm actually measuring kind of the average divergence. And this is what this rule says. It says when that difference crosses above its 9-period average, if you will, really it's 9-period standard deviation, then fire a signal. In other words, this is telling me when the white line pulls away from the cyan line, plain and simple. And all you need to do is you can tweak the speed. You can really think of this as an average in this case. I mean, it's standard deviation. It's defined to be the average of the residuals, the difference of the residuals, or I'm sorry, the difference is from the mean, actually. The residuals comes into play when you do linear regression, but it's the average of the differences from the mean. So in other words, you can really think of this as a 9-period average of these spreads between the white line and the blue line. And that's all it is. And what happens is somewhere around here, it's going to say this white line is really pulling away from the cyan line, and that's where it's going to double down. And that's where you can tweak this add to position for how it decides whether or not it's pulling down. Right? So for example, I can play with this. I can, for example, change the speeds of these moving averages. Maybe I want to, instead of comparing the white against the cyan, maybe I want to compare the cyan against this peach line, and maybe somewhere around here is really where it pulls away, or maybe I think that's too late. All I know is that for this basic example, this is working well for me, and so that's why I'm kind of sticking with it for now. But that's all this is. This is a really simple rule in order to say when the 3-period EMA pulls away from the 20-period EMA. And when I build this rule, all I have to do is go to step 2, the strategy builder, the management, my rules. I can drag this out, drop it right into the add position. I can tweak the parameters, save it, and now it's saved under my strategy. And of course, you run your back test. And whenever you deploy, we have links here under step 4 where you can deploy to the RTS strategies and the trade optics. But that's really all there is to the add to position. The trick is doing something that makes sense. Now, that's a really important point, doing something that makes sense. The add to position should really be a confirmation type of play. So in other words, when you're creating automated trading strategies, right? There's many different ways to create automated strategies. I could create strategies that are based on long-term trends combined with pullbacks, and that's really what this strategy is all about. It's looking at a moderate trend, which is influenced obviously by this peak here, but it's using a moderate sized trend with a pullback, and that's firing my signal. Well, oftentimes, people talk about leading indicators versus lagging indicators. And leading indicators, the idea here is, you can't really predict the future with these things, but you can measure things that kind of give you some degree of indication of whether or not thresholds are being reached or various overbought or oversold conditions are being reached. One of the great examples are the pivot points. Pivot points are really telling you, these generally agreed upon thresholds for support and resistance. So in other words, if you are hitting, say, an S2, let me pull up the Shadow Trader pivot points. Let's see, where was I? Shadow Trader pivot points. And this is really showing you the ones that are relevant for today. But here's, you know, on XOM, and I'm not making any calls or anything like that here, but here's one where it's really digging into S3, right? And unless, let's take a look at the, you know, the market indicators. It is a pretty down day, right? But you could generalize here that perhaps, since this stock is hitting its S3, perhaps it's really hitting its support level, and it might not be a good idea to short. It might be kind of too late to short. Now, it might have been great to short on the open because it was, you know, between this S1 and this S2, but when you're hitting this S3, that's almost like a leading indicator that perhaps this trend is going to maybe not stop, maybe not completely cease, but maybe for the rest of the day there might be maybe a little pullback or some consolidation. But that's a great example of leading indicators, and other such examples are CCI, that's the Commodity Channel Index, the RSI, Relative Strength Index, stochastics, and various things like that. But if you have a strategy that's based on a leading indicator, you might want to get into that position and then later confirm that position with an add to position. So for example, I can always specify my risk parameter settings in my portfolio, and I can say get into position using fixed share sizes or fixed percentages. And I could, for example, let's see here, I've actually got this locked here. Let's do 2 1s here. Right, and let's see, the spins in terms of 100. But if I said fixed share size, oh, I don't know, 50 shares, for example. Right, so let's say I had 50, and 50, let's say, okay, so it's actually not letting me do a fixed share size of 50, but I could do this as a percentage. Right, and let's say that percentage was going to get me into 30 shares of a position. If I use my leading indicator in order to get into the you know, 30 shares, right, I could then back that up with a confirmation, which then doubles down the 30 into 60 or more shares. Right, and so that's an example of how you can actually do this. Right, now that's true. There's no such thing as, you know, leading. Right, you know, you can't predict the future. Right, however, you can give yourselves indications. Right, and I'll give you an example. I usually apply these examples to the weather. If, for example, you know, various dew points or whatever, or if, you know, you have winds coming up from north to south, you could consider this as a leading indicator that perhaps there's a fair chance that that's going to continue, and the weather pattern is going to, you know, come into your area coming from north to south. Whatever. Really, the main point is that these indicators are giving you indications that something may happen. And if you are going to make a trading decision, you know, based on, you know, a combination of these things in order to get a favorable entry point, you know, another good example are reversals based off of Bollinger Bands, then one strategy is to get into position based on that signal so that you are at least have your foot in the door, and then when that's confirmed that it is an actual good position, that's when you get into your real position. Right, so the way that you do that inside of Prodigio is quite simply just adding into the add position management rules inside the strategy builder. So it's as simple as that. So the last thing that I want to do is I want to try to explain how you can apply this to MACD. Right, so this rule, and of course this rule, I'm going to post this out there right on the website on www.prodigiorts.net. That'll be up there on the blog, and you can just import that right into your Prodigio Wizard Lab. And to import that, I'll put the whole strategy down here. You can go into Wizard Lab, and once you've saved it to your computer, you just go right into import, and this is starting in my My Documents folder, but you just point right at the strategy and hit open, and that's going to import it in for you. So here's the rule as it applies to just the exponential moving average. Well, let's take a look at the MACD. Now, I have no idea if this is going to improve the strategy in any way, but at least I'll be able to kind of show you how you could do this. So looking at this same position, let's see. Well, actually, this is a different. This was XOM, and I moved forward to a more recent date. So let's go back to that really good example, and this was the good example actually. To the various exponential moving averages inside the MACD. All right, so let's just go off of a 329. Now I got my signal exactly here, at 11:40 on the 1st of June. Now what happens is these MACD speeds, when things are consolidating, these MACDs are really about the zero line, and then what happens is they begin to pick up. Now perhaps these I'm looking at this chart, and this looks a little bit too choppy to me. It looks like it's too slow, so I'll actually increase this a little bit. Let's keep the fast at 3. Normally this is 26 and this is 9. So let's go back to something more traditional. And I still think that's a little bit choppy. Let's put it at 10, 26, and 9. Okay, and here's something that's a little bit more smoothed out. Now what's going to happen with the MACD histogram, and again, that's the green bars and the red bars. That's just like in the earlier example, it's the difference of this orange line minus the red line, and that makes the green bar. And then the red bar is formed by, it takes this orange line again minus the red bar. And it's a negative number in this case. When the orange line's below it, it's a negative number, and that's why it's a red bar. It's below the zero line. So that value is negative 0.08 at that time. Well, really, I'm just going to measure the divergences in the MACD against what its basically average is. I'm going to use the same technique. Now you could use other things. You could use things like linear regressions. You can use various comparison operators, etc. All that stuff is here in Wizard Lab, and it's all over here inside the technical analysis toolbox and the math operators, etc. But let's run this on MACD. So I'll scroll down. And now notice MACD is split out into 3 parts. There's the MACD line, the MACD signal line, and the MACD histogram. Each one of these studies represents one of the lines that you can see on the chart. And you might want to use any one of these 3 different lines in any different context. Right? So for example, here's the orange line, and here's the red line, and here's the histogram line. Each one of those rules is represented as a different study inside of Wizard Lab. So we're going to focus on just the histogram. Just like we took the difference of the white line and the cyan line, we're going to use this MACD histogram to represent that difference. So in order to replace it inside Wizard Lab, this represented the difference. I can now remove this I can replace it with a MACD histogram. And I'll want to match my parameters to what I had on the chart, which was 10, 26, and 9. And now I'm kind of doing the same thing just on the MACD histogram. It's taking the absolute value of the MACD. Right? So remember, absolute value, it's going to flip it positive so that if it's all these red bars are basically going to become green bars. It's the absolute value, so it's just going to flip it to the upside. And the reason why we're doing that is so that we can make this an ambidextrous rule. You don't have to do that. You can make this either a positive rule or a negative rule, and you would just use some simple logic. If it's greater than 0, less than 0. But I'm making it ambidextrous by using the absolute value. Right, and we can do the same thing down at the bottom. Now I can always let me remove some of this. I can always right-click on the MACD histogram, copy, and I can right-click and paste. There's another copy of that MACD. And now I'm doing the exact same thing. Now let me position this the right way. I just hit Control A there. Control A allows me to grab everything at the same time. I can just rearrange this so that it's a little tighter, especially if I want to use this in another rule. It's nice and compact. And that's saying take the absolute value of the MACD histogram and let me know when it crosses above its 9-period average, more or less. Now you can use a moving average, but this standard deviation, it works really well when you have kind of volatility indicators. Actually, yeah, that's still going to work. That's going to be pretty good. So let's save this as breakout, breakdown, MACD. I'm going to save this. I'm going to replace this in the trend down strategy. And this may do better, it may do worse. I'm going to actually guess that because of the lagging component, all right, I'm going to guess this does a little bit better. Let's try it. So remember these numbers, 15,500, 575 to 941, and let's run that. And the reason why I think this is going to, now I could be completely wrong here, but I think that the other indicator was a little bit eager to double down on the positions. And the way I knew that was by looking at the results, and I saw the majority of them actually had the 200 shares. Now it looks like this was slightly worse, so it's not true. But notice all of these open share sizes, 200, 200, 100. It's actually doubling down in a lot of cases. Right, so a lot of these, it is actually less than before, but again, maybe that's because it's taking away some of the profits. So let's try to change that. Let's try to make it not double down so much. But again, I'm using the MACD. So this is a trade on May the 5th. Let's see, so May the 5th. Again, I'm using the MACD in order to determine when to double down, and this was a good idea in this case. Somewhere in this area, the white line, or actually the MACD rather, and it's probably going to be closer. Maybe this actually was too late. You see how the MACD starts to diverge at around here later on in the day? That's actually at the end of the move, so maybe that's why it's doing worse. Maybe this is actually a little bit too late. But you can tweak these parameters as appropriate. So let's do that. So maybe I was concerned too much about slowing down this MACD. Let's speed it up again. Let's go back to the 3-period. And you'll notice that this will again be a little more eager either in here or here to double down on the position. Let's see what that simple parameter change does by changing the MACD back to 3 periods. See if this makes any difference. So I'll go back into the rule builder. I'll change this fast length to 3. And all I have to do is save the rule here. I don't have to change the strategy because I've already got the breakout, breakdown, MACD as part of the strategy. I only need to change the rule. Make sure you hit save. You have to hit save. If you don't hit save, it's going to run the old rule. So make sure you hit save. Run that. May do better, may do worse. I don't know. Let's find out. And you'll want to really analyze this in detail. I spent quite a bit of time this morning coming up with the concept, but really you want to really refine this so that it makes sense. You know, you want to look at your not only your good trades but also your bad trades as well. This one did do better. It's got a more positive net P&L, but the winners to losers ratio, it's a little bit worse. So it's definitely making different trade-offs. I wouldn't consider this a significant improvement over the original strategy, but it is an example of how you can look for these breakout, breakdown divergences by using standard deviation and using the add to position part of the strategy builder in order to confirm good trades. Right, so that's very that wraps up what I wanted to talk about from the beginning of the presentation. I'll try one more thing, and I probably, since I'm doing this very, very rapidly, may not have the best success with this, but let's try to do this off of an RSI. Right, now an RSI is very, very basic. Perhaps by itself is not the most informed technical analysis indicator. You really want to use RSI with other indicators, but let's try to trade this RSI off the 5-minute, and we're going to try to go long when it crosses above 30, and we're going to try to go short when it crosses below 70. And we're going to use the add to position as kind of a confirming indicator. Right now I can tell right off the bat I do want to have some kind of trend involved, so I'm probably going to keep the trend side of this. But let's take a look at this. Okay, so I'm going to go back to my original strategy, the trend down. And again, I want to emphasize, right, that these strategies are very basic, right? Hopefully, what you get out of this is the techniques on how you can do these different things inside of Wizard Lab. You need to really take, your knowledge and your experience and experiment and apply, what you know about trading in order to make, good trading strategies. I will do the best that I can to kind of, lead you in the right direction. But again, a lot of my time is spent on building the mechanics, so bear with me. But I like what I'm seeing out of this so far. Now, this trend down rule had the moving down part of it, right? And that was, again, it was a very, very, very simple way to say that the 20-period EMA is above or below the 50-period EMA. I'm going to replace this cross down with kind of my RSI indicator. Right, so let's make that RSI indicator. I'm going to say new, make this 5 minutes, and I'm going to use RSI. And I actually only need one RSI, I think. So what was I looking at on the chart? So 10-period RSI. So let's copy that. And I'm just going to look for when it crosses above 30. So I'll need a constant operator to represent my 30. All right, so I'll save this as RSI cross above 30. And let's see, I was focusing on the short rule, so let's just use the short rule because I need to wrap this up. So let's say cross below. And now I've got a simple Wizard Lab rule that's going to trigger whenever the 10-period RSI crosses below 70. All right, so we can save this as cross below and 70. Remember, 70 and 30 are usually the inverses of one another using the RSI. And I'm going to open up this trend down rule that I have, and instead of cross down, I'm going to use this RSI cross. RSI cross below 70. All right, and let me save this as trend down RSI, just so that I don't confuse it against the other rule. Right, so I'll go into my strategy builder. I'm going to replace this trend down with trend down RSI. And save this as trend down RSI. And that should do it. Let's see what that does. May or may not be any better than the other one, but let's see. At least with these results, I'll be able to show you how it's getting into position when the RSI crosses below 70 as opposed to waiting for the EMA cross. Now perhaps a good, okay, so this one was extremely uninformed, right? So see, this is just nothing but losing trades. All right, so you definitely wouldn't want to start using this right away. You would want to find some kind of thing that meets in the middle. And you know what? Just by looking at some of these results, I can start to tell why this isn't doing as well. Let me show you this. So this RSI, when this is kind of crossing below 70, this is getting into position. Oh, did I flip this the wrong way? I did, didn't I? Thank you. Well, that makes sense. Let's save that. Okay, so now it's short. All right, so I was the opposite way. And while that's running, let me see here. Yeah, trend down was short, so I had inadvertently flipped it back to buy by accident. All right, so that's a little bit better. That's not so bad. You're right, I had this flipped incorrectly. So it's going short these positions. Let's take a look at this. So what this is doing is it's finding times when this crosses below 70 and it's getting into the position. So in other words, this is really a time where it hadn't really yet changed its direction, but you're kind of anticipating that it might change its direction. That's the difference between waiting for something to be confirmed versus kind of anticipating reversals or changes. So here's how you could use it off of RSI. This is a favorable trade, but they're not always going to be that way. And the way that you can tell is these results are nowhere near as positive as the results of the other strategy. So take that for what it's worth, but I hope what you got out of this chat today is how you can use the add to position and how you can start to build strategies that kind of manage the difference between anticipatory signals and confirming signals. You know, there's always that balance, but you can kind of build these rules in together using the rule builder, so you can have them kind of offset each other, etc. And then if you have a strategy that gets into position and seeks confirmation, the way that you use that inside the strategy builder is by dragging the rule into the management add to position part of the strategy builder. I hope that you guys found this interesting today. I'm going to wrap it up by saying follow us here every day. Every Wednesday we have these chats at 11 o'clock Central, 12 o'clock Eastern, and our goal is to really demonstrate features of the Prodigio platform, talk about some of the questions that we get. We try to kind of aggregate those questions into chats. For example, we got a lot of questions about this add to position. It can be very powerful as long as you know how to use it. But yeah, you know, we always try to mix it up. So yeah, this is a little more advanced and, you know, less introductory. You know, we still every now and then we try to do these introductory chats to kind of get more people on, but at the same time, you know, we try to bring in some more advanced discussion as well. There's a lot you can do with it, so if you don't have activation, please request Prodigio activation by sending your email into support@thinkorswim.com, subject line Prodigio activation. As always, my name is Brian Wagner. I'm the chief architect here with the very always perpetually busy Prodigio development team. Hope that you got a little something out of this today, and we'll see you here next week. So as always, great trading everybody, and take care.